Hello traders, welcome again to Jugos FX 2022 mentorship. So today we are going to be on phase 2 sub A, which is Forex analysis. The first sub A that we're starting with is Forex analysis. We're going to look at Forex analysis, types of Forex analysis, which one is much preferable and all those things. Okay, so those are the things that we are going to look out for on this particular session. All right. So let's start with it. What is Forex analysis, types of Forex types, and all those things. Okay. So what are, first of all, analysis? Okay. Analysis is just like, I don't know which particular word to use, but it's a way of looking at something in a very deep way, or how do I put it here? Looking at something deeper, okay, for it to give you a meaning or for it to give you an information. Okay. So with Forex analysis, we have three types of analysis, which is fundamental analysis, technical analysis, and the sentimental analysis. So starting with the first one, which is fundamental analysis. Fundamental analysis is a way of looking at the Forex market by analyzing economic, social, and political forces that may affect currency prices. Okay, like for example, wars that happen in an area in a country, things like that. All right. If a country is having political crisis or whatsoever, let's say war, or the president of a country dies, I mean, it's going to affect their currency. It's going to affect their economy, and so it's going to affect the rate of their currency. Okay, that's fundamental analysis. All right. So, like for example, in the United States, there are a lot of fundamentals that happen there and they affect the economy. Okay. So there are people who base their trading only on fundamentals. They are just there accessing the economic, analyzing economics and social political forces in concerning a particular country that will affect their currency. And because of that, when they analyze and they see it, they benefit from those, they benefit with their investments on those political crises. Okay, like for example, when I will go to the chart, I'm going to show you about Russia and Russia, as they are having crisis with yeah. So they're having, when you look at the chart of Russia, you discover that it has when you look at the economy of Russia, it has affected their currency. Okay, it has affected their currency very much. All right, they are not stable because of the war in Ukraine, and I mean, it's not even the Ukraine itself. You look at the economy, it has dropped drastically. It is very, very bad. So all this, it affects their currency rate. All right. So the second and most important one, which is the one we are going to be mostly using, is called technical analysis. So what is technical analysis? Now, technical analysis is a range of techniques used to try and forecast future price movements of financial products based on historical price movements and patterns. Okay, foreign exchange markets are particularly well suited to using technical analysis. So technical analysis is just simply a way that you can use to study past, I mean, you study past price action. You look at price you look at the history of something, and then to determine the future. And like we normally hear this saying that history repeats itself, right? Which means that what happened before, it's likely to happen again. All right. For example, let's say a president now, let's say like 2010, an American president was dead, and then the economy of the country was affected. So suppose another president dies again, it's going to happen the same, right? It's going to affect the currency the same. So those are the things. Technical analysis is like you study past price action, you study the movement of price, the history historically, the movement of price historically, and then it's to be able to know, to forecast what is going to happen ahead of time. All right, that's the main thing of technical analysis. We are going to go deeper with this technical analysis. Okay, so the next one is called sentimental analysis. Now, this sentimental analysis is not widely used, but it's very, very important. Sentimental analysis is used to gauge how other traders feel, okay? Whether it's about the overall currency market or about a particular currency, you're trying to look at what are these traders thinking? What are they doing? Or what are people, what is the general public expecting now? Okay, like for example, let me just give a clue about the Bitcoin. I think by now, everybody, all the traders are like thinking, okay, Bitcoin should at least start buying, all right? They are waiting for a bull run. So that's sentiments. Okay, you're trying to understand. A lot of people now are like trying to have they are trying to, they're looking for a turnaround from Bitcoin so that it should start moving, going up. That's sentiment. Okay, just you are trying to gauge how other traders feel about a certain currency, product, or whatsoever. Okay, so now talking about technical analysis, we have, it deals with charts, all right? And this is a chart here. This is a chart. This is a Forex chart, okay? So anything that you are doing here, whether you are drawing whatsoever lines, you are drawing anything that you are doing here, you are doing technical analysis, all right? You are doing technical analysis, whether whatsoever you are doing, you are drawing lines, whatever, I mean, in this chart, anything that you are doing is called technical analysis right here, okay? So, but when you talk about technical analysis, there are things that are involved that traders look into, all right? Which we have types of charts, all right? Now we have a bar chart, we have a line chart, we have candlestick chart. Now, when you look at this, this is called candlestick chart, okay? If I want to change this to a bar chart, I'll click here. This is a bar chart. Let me get it for you. Okay, so you see it has changed completely. This is a bar chart now, all right? I'm going to teach you how to read candlesticks, okay? That's a video on its own. But this is a chart, this is a bar chart. Some traders, they use this, have the open, close, and the low. And then some use the line chart, all right, which is this. This is a line chart, okay? I'm just showing you the types of charts that are mostly used. There are a lot of them. We have a lot of them, as you can see here, but these are the three most used charts. And we are going to be focusing only most on these candlesticks because it tells a lot, it gives us a lot of information that we need, okay? It gives us a lot of information that we need. So when you see price pushing up like this, price is buying. And if it is buying like this, it's because of something, all right? That's, it tells you, it gives you a story, all right? When you look at a candle, when a candle closes like this, it tells you a story. When it closes with red, it tells you a story. I mean, when you look at the chart like this, as it has been dropping, it gives you a story, okay? It gives you information that you need, right? That's why, that's the main reason for this candlestick chart, all right? It tells, every candle has a story to tell. Every candle has an information to give you, you understand? So like I said, if you just draw an imaginary line like this on your chart, and then now, price came here, sold, price came here and then went down, came here again and went down. So the reason why I said history repeats itself is like a trader will be waiting for price here again to come and touch the line again, and then he sells. Why? Because it did touch, previously sold, touch again, sold, and then he waited again, the price should come there, and then he sold. Okay, we call this line a trend line. We are going to go deeper to that, all right? So price touch here, sold, touch here, sold, and then, like I say, history repeats itself. Traders will be expecting to sell here again, and you see price came, touch it, and then sold off. That's, they will make money from that movement, okay? And again, now you will discover that price came to this level, went up, then came again to that level, went up again, and then came to this level again. So traders again will be expecting that at this level, price should go up again. You understand? So it's simply, that's simply what technical analysis is all about. All right, that's simply what technical analysis is all about. Looking at past price action, seeing what price did before, and then you're trying to use that to be able to forecast what price is going to do next. Okay, so now I've said we have types of chart. We have, like, we are going to focus mainly on three types of charts, which is the bar chart, line chart, and candlesticks. All right. So now some other traders, technical traders, they also use indicators. What is an indicator? Is simply just like a tool that gives you some information that shows you a direction of the market. All right, we have this one. This is called MACD. I shouldn't have been putting S here. This is called MACD. All right, it's MACD, not MACX. Moving average, yeah, divergence. We have RSI, we have stochastics, we have Bollinger Bands, EDC, etc., and robots. All right, all these things, you can have them on your phone, okay? If you look on your phone, you are going to see all these indicators. You are going to see all of them, all right? Now, the last one we have is called a robot. Okay, what is a robot? A robot is simply, now, a Forex trading robot is an automated software program that helps traders determine whether to buy or sell a currency pair at a given point in time. All right, that's what a robot is. Traders have robots. They are built in to give you some information about, like you can say, all right, now, for example, looking at this chart, you can say, you can build a robot to tell you that, okay, if this is, you load the robot here and then you say, you give the command to the robot, right? That if price touches a line, touches again, then when it's coming to touch again, that robot should sell, all right? So when you launch your robot now on this chart, immediately price comes to this level. If you are not there, the robot is just going to sell, all right? That's what that's the work of a robot. It's just going to enter the trade for you without you doing anything. Okay, that's the work of a robot. It's automated based on your strategy, how you trade. Like for example, you can give the command to the robot that if price touch a level, go up, come back, touch a level again, and go back up. When it is coming again to touch a level, the robot should buy. So the robot now has a command. It's just waiting for price to touch a level, go up, come again to that level, go up, and then the third time the robot is launching a buy order automatically. Okay, you're just going to see profits. Okay, now you can tell the robot, okay, if you enter the buy, put the stop loss of 20 pips, put a take profit of 30 pips. As simple as that. Immediately price comes, the robot is just going to launch a trade for you automatically. All right. But now, why robots are not mostly used is because price evolves daily. All right. The movement of prices evolves daily. You might actually be looking at a place like an area of resistance, but the movement of price towards that area will not be good. So a robot will not be like a human being to reason out this particular situation. That's why a lot of people don't use robots, because they are not so efficient. Okay, some robots work, but some doesn't really work that way. But the market is evolving every day. The market is evolving every day. All right, that's why robots doesn't work that way. Okay, they don't work so much that way. All right, I want to check I want to check the pair of USD Russian ruble. Okay, let's check it. Let me go to daily time frame, or what, even if months. Okay, so look at this pair here. This is the weekly chart. All right, it means that it has been dropping. Now this is the chart of Russia. You discover immediately the crisis started. All right, the crisis started, it started dropping, it dropped for a long time. So traders that are fundamentally, they will be looking at this kind of opportunities. Once they hear that these people are trying to have an attack, all those things, they begin to invest, they begin to sell that currency. As they're selling, they are making profits. All right, that's simply how fundamentals they trade. All right, and there are a lot of release news, as like I said, that gives some major movements to price, and fundamental traders, they wait on those releases. Okay, like for example, let me see, Forex Factory. Let's see. Okay, now this site is called Forex Factory. Okay, and it is a site where fundamental traders use. They use this site to look at their news releases. All right. So if you look here, you will see that this is Friday 30th. You see that currency, impact, and then this is the news, all right? You see unemployment rate for the Japan, you discover that it has dropped instead, all right? This was the previous one, 2.6%, but it has instead dropped to 2.5%, and this is backed for the currency, okay? Now, just 130, just some, I think 1 hour ago, as I'm recording this lesson, this was a news on the US dollar, all right? When you see red, it shows that it's high impact news, all right? It's called core PCE, price index. So now the previous of this release was 0.0%. And then now the actual price, I mean, the release now is 0.6%. This is actually good for this currency, okay? So let's look at it. So this news deals in the change in the price of goods and services purchased by consumers, excluding food and energy. That's the main purpose of this release, okay? It looks at a change in the price of goods. So meaning that there's a change, there's a positive change in the price of goods and services purchased by consumers, excluding food and energy in the United States. Get it now. So this news release is released monthly about 30 days after the month ends, okay? So that is why traders care. It's the Federal Reserve primary inflation measure. Inflation is important to currency valuation because rising prices leads the central bank to raise interest rates out of respect for their inflation containment mandate, all right? So this is it, personal consumption expenditures, PCE. That's the full meaning of it, Consumer Price Index, CPI. So that is the release that happened today. It was actually positive for the dollar index. So let's just check out the dollar index and see if this release has had an impact in it. Let me go to 1 hour. All right. So when you look at the release, you discover that, okay, price has been pushing up, all right? So that is the effect of the release. It was more than the previous one, which is an advantage for this currency pair, which is an advantage for the UK. You get it? It's very, very important, guys. It's very, very important, all right? It's very, very, very important to look at the news. We are going to do fundamental analysis, all right? To be able to know the types of news that are going to be released and so on and so forth. Okay, there is one called NFP, which is very strong. We're going to talk about all those things. So just to round up with this video, I'm going to teach you how to read candlesticks. And then in our next lesson, I'm going to enter into liquidity. That will be our next lesson, right? So let's just quickly look at how to read candlesticks, okay? So let me see. Okay, just give me a second, all right? I want to okay. I want to use this one so that I'll make you understand very well. All right. Now, this white candle is called a bullish candle. The black one is it's a bearish candle. So when this is how it opens. All right. For a bullish candle, it opens down. For a bullish candle, it opens down, right? It opens and then it trades up and then it closes. All right. So now, when it opens here and then trades up and then closes at this level, this now is called the close. This is called the open. All right. And now you can see that most of the time it can open and then it first of all trades down. Before now it comes back up, it goes and reaches a certain level, then it comes back down and close here. So this is called the high, and then this is called the low. All right. So for example, looking at this one, okay, this is the low, this is the open, this is the open, this is the low, and then this is the close, and then this is the high. This is the high of the candle. Okay. Now, talking about a bearish candle, it opens up The bearish candle does the opposite, okay? It opens at this level. It can trade up a bit. It comes back down, and then now it closes at this level. That's what a bearish candle. It opens. This is the open. This is the high of the candle. Down here it is the close. All right. A bearish candle closes down, and then here is the low. All right. For example, this is a bearish candle. This is the high of the candle. This is the open of the candle. Open, high. This is the close of the candle where the body ends, and then this is the low of the candle. So this filled portion is called the body. All right. This is the body of the candle. All right. And then now this lines up. This is called wicks. Okay. It is called wicks. It is called a wick. Okay. Now look at this current candle that is trading now. This candle opened at this level. It went up, created the high. Okay. It created the high. This candle has not closed yet. All right. It has not closed yet. It still have like 15 minutes, 25 seconds to close. All right. And then since it opened here, we can be looking at, okay, it can trade down to somewhere here. And then now it gives a low and maybe close somewhere. You get it? So that is how candles formed. All right. When you are looking at the candlestick, you look, where did this candle open? Where did this close? Now, this is a bullish candle. It opens down. This one closes and this one opens. Okay. That is how it functions. Now, this is a down candle. It opens up here, came and closes. When it closes here, immediately the second one opens at that level. All right. This one opened, traded down a bit, give the low, and then it went up and then closed exactly here. All right, without even giving a small high. So it's not a must that it must give a high or a low. All right. It can be like this one, just block, just the open and the close. Okay. But if you see a wick up for a bearish candle, that's a high. Wick up for a bullish candle, that's a high. Wick down is a low. Here is the low. All right. For a down candle, this is the close, but for a up candle, it closes up. All right. So now, how do you read these candlesticks? Now, look at this movement. When you see bullish candlestick like this, what does it tells you? What information does it gives you on the chart? This tells you that the buyers are present in the market. Okay. People that are buying are present. I mean, buyers are more than sellers in the market. Let me put it in a physical way so that you understand. Now, suppose that you are selling, let's say you are selling shoes in the market. Okay, you are a shoe seller in the market. Now you have like 100 shoes. You have 100 shoes to sell on a particular market day. You have only 100 shoes to sell in a particular market day. Now, when you go to the market and you discover that there are 1,000 people just to buy that particular shoe, right? Suppose that this person was selling this shoe for 10,000 each. Okay. So now when you go to the market and you discover that we have like 10,000 people just to buy this particular shoe, and only one person is available to sell the shoe. As a businessman, what are you going to do? At this point, it means that demand for that shoe is high. All right. So when the demand of the shoe is high, what happens is that it's going to push the prices of these shoes up. So instead of selling for 10,000, this person can now be selling one shoe for 20,000. You understand? Which means that for the chart of this shoe, you are going to see the chart going up. All right. It's going to leave 10,000 and then you go up to 20,000. You understand now? Why? Because the demand, this is the demand. A lot of people, the demand for the stock is too much. It's more than the supply. So therefore, prices of it have to go up. That's basic economics. Okay. When the supply of something, when the demand of a particular stock is much, it pushes prices up. Okay. So now, again, let's suppose that this person, let's say 100 people came to the market to sell these particular shoes. All right. Each person having 100 pairs, 100 pairs, 100 people, each person having 100 pairs. And in this case, only 50 people came to buy the shoe. And each shoe was to be cost 10,000. Suppose that this is the market of the shoe and this is 10,000. What will happen here is that The supply is much. The supply is much, right? Remember, we have 100 people in need of this particular shoe. Now, 100 people with 100 businessmen with 100 shoes that they are selling. So at this point, so the people that are buying are only 50. So what happens? The supply will be more than the demand. And if a supply is more than the demand, the price will have to drop. So the price of the shoe will even drop to around 1,000 instead of 10K. You understand now? So here in this case, supply is more than demand. So when supply is greater than demand, okay, prices go down, prices sell, all right? That is, prices drop, it goes down. Now, when demand is greater than supply, what happens is that prices, they go up, we buy, okay? With Forex term, you buy, okay? You buy it. When supply is greater than demand, you sell, prices drops, okay? As simple as that. Now, remember, I always like to quote this. During December, you are going to see that the demand for clothes will be very high, will be even more than the supply, which means that the businessmen that will be selling clothes will not be up to anything as compared to the people that are buying. What will happen is that stocks of the prices will rise, okay? Prices of clothes will rise drastically, all right? When they are rising, it means that they are bullish, okay? And the prices will be going up. So as a businessman, you buy things when they are low, and then as prices goes up, that's when they will go, that's when you sell, when they are high, okay? You buy low and you sell high. I talked about this on our last video, all right? That's how things are done. When the demand of something is high, prices goes up. When the supply is more than the demand, I mean, prices drops, right? That is it. So when you see the market dropping, know that supply is more than demand. When you see the market going up, know that demand is more than supply. Now, demand here refers to buyers, okay? Demand here refers to buyers. Supply here refers to sellers. So when the market is dropping like this, it means that sellers are more than buyers in the market. Sellers are more than buyers in the market, all right? So if you look at this chart, you will discover that from here, prices started to drop, okay? Sellers were much in the market because why? Prices have been rising. Prices have been rising. When it reaches this level, like I said, you sell at a higher price, a lot of people started selling, all right? When they start selling, what happens? Supply is more than demand now. Prices will start to drop. These people that are selling, they are making profit. It dropped to a certain level. Buyers wanted to enter. Sellers again were still present. They were still more than the buyers. It pushed price down again. That's how it is, okay? As simple as that. There's nothing to hit your head whatsoever. It's very simple, okay? That's how technical analysis is. When you look at the chart, when prices are going up, it's giving you a story that these people demand for this market is high, this is and that, all those things. We are going to go deeper to know areas of supply, areas on demand, areas where buyers are sitting, areas where sellers are sitting, okay? That will be done in our next video, all right? But for now, that is what Technic Forex analysis is all about. We have talked about all those things. Now, I think I've explained this all, okay? Phase 2A. So in our next session, we are going to be talking about liquidity, which is from phase 2, sub B. After that, we are going to go right. That will be all for phase 2, and then we'll go now very deep to phase 3, which is almost like the most important session for this training, okay? So thank you guys, and get to work, back test, look at your charts. If you have any questions, I'm going to go for a live session and I'll answer your questions, okay?